everyone. I'm Maril J. Belisario and I will continue the topic for Chapter 14. Chapter 14. Accounts receivable turnover. The accounts receivable turnover and average collection period ratios are used to measure how quickly credit sales are converted into cash. The accounts receivable turnover is computed by dividing sales on account. Assuming that all Bricky Electronics sales were on account, its accounts receivable turnover for 2007 is computed as follows. The accounts receivable turnover can be divided into 365 days to determine the average number of days required to collect an account known as average collection period. The average collection period of Bricky's Electronics for 2007 is computed as follows. This means that on average it takes 35 days to collect a credit sales. Whether this is good or bad depends on the credit the term Bricky's Electronic is offering its customers. Many customers will tend to withhold payment for as long as the credit terms allow. If the credit terms are 30 days, then a 35 days average collection period would usually be viewed as very good. And on the other hand, if the company's credits terms are 10 days, then a 35 days average collection period is worrisome, and a long collection period may result from having too many old uncollectible accounts, failing to bill promptly or follow up on late accounts, lacks credit checks, and so on. In practice, average collection periods ranging all the way from 10 days to 180 days are common depending on the industry. Inventory turnover. The inventory turnover ratio measures how many times a company's inventory has been sold and replaced during the year. It is computed by dividing the cost of goods sold by the average level of inventory. Beginning inventory balance ending inventory. Bricky's inventory turnover for 2007 is computed as follows. The number of days needed on average to sell the entire inventory, called the average sale period, can be computed by dividing 365 by the inventory turnover. The average sales period varies from industry to industry. Grocery stores with significant perishable stocks tend to turn their inventory over quickly. On the other hand, jewelry stores tend to turn their inventories over slow. In practice, average sales period of 10 days to 90 days are common depending on the industry. A common whose inventory turnover ratio is much slower than the average for its industry may have too much inventory on the wrong sorts of inventory. Ratio analysis. The long-term creditor are concerned with a company's ability to repay its loan over the long run. For example, if a company were to pay out all of its available cash in the form of dividends, then nothing would be left to pay back creditors. Consequently, creditors often seek protection by requiring that borrowers agree to various restrictive covenants or rules. These restrictive covenants typically include restrictions on payment of dividends, as well as the rule stating that the company must maintain certain financial ratios at specified levels. Although restrictive covenants are widely used, they do not ensure that creditors will be paid with loans come due. The company still must generate sufficient earnings to cover payments. Times interest earned ratio. The most common measure of the ability of a company's operation to provide protection to long-term creditors is the time interest earned ratio. It is computed by dividing earnings before interest expense and income taxes by interest expense. For Bricky Electronics, the time interest earned ratio for 2007 is computed as follows. The times interest earned ratio is based on earnings before interest, expense, and income taxes because that is the amount of earnings that is available for making interest payments. Expenses are deducted before income taxes are determined. Creditors have first claim on the earnings before taxes are paid. Clearly, a time interest earned ratio of less than 1 is inadequate because interest expense exceeds the earnings that are available for paying that interest. In contrast, a time interest earned ratio of 2 or more may be considered sufficient to protect long-term creditor. Debt to equity ratio. Long-term creditors are also concerned with a company's ability to keep a reasonable balance between its debt and equity. This balance is measured by the debt to equity ratio. The debt to equity ratio indicates the relative proportion of debt and equity on the company's balance sheet. In 2007, creditors of Brick Electronics were providing 85 cents for each $1 being provided by stockholders. Creditors and stockholders have different views about the optimal debt to equity ratio. Ordinarily, stockholders would like a lot of debt to take advantage of positive financial leverage. On the other hand, because equity represents the excess of total assets over total liabilities and hence a buffer of protection for the creditors. Creditors would like to see less debt and more equity. In the practice, debt to equity ratios from 0.0 to 3.0 are common. Generally speaking, in industries with little financial risk, creditors tolerate high debt to equity ratios. In industries with more financial risk, creditors demand lower debt to equity ratios.